Hello, Jeff Parker here with HomeWatch. What I'd like to share with you now is a strategy on how you can lower your FOPI score and prevent or avoid foreclosure. This strategy is a loan modification. In a loan modification, the bank is willing to modify your existing loan terms in response to your inability to repay the loan over the long haul. Loan modifications typically result in one of four changes: a reduction in the interest rate of the loan, an extension of the term of the loan, a principal reduction in the loan balance, or a different type of loan altogether. A lender might be open to modifying a loan because it's cheaper than the cost of default and foreclosure. The good news is that if a workable solution, a workable loan modification can be negotiated with your bank, you and your family get to stay in your home. The new loan terms may put your family in better financial positioning because your new loan may take advantage of lower interest rates and current home market prices. In addition, a successful loan modification can actually improve your credit score over time, especially if it prevents you from ending up in foreclosure or bankruptcy. Any homeowner can approach their lender to start the loan modification process, but in the end, it's the bank that ultimately decides which loan modification applications it will approve. If your mortgage is in default or your payments have increased dramatically, there's a higher likelihood that your application will be considered by the bank. The top factor that the bank will use in determining whether or not your loan modification will be considered is your current income. You can find legitimate loan modification assistance by calling your lender or your local housing authority. Remember, foreclosure is a legal process, so contacting a qualified real estate attorney is also appropriate. The federal government has created the HOPE hotline that is available 24 hours a day, 7 days a week at 888-995-4673 to find agencies and organizations to help you get started. The earlier you begin the loan modification process, the more likely you are to receive a loan modification because the foreclosure timeline is limited. Now keep in mind that the banks are overwhelmed with the sheer number of loan modification requests that they receive every day. The best time to start your loan modification is when something drastic has occurred financially to your family. Large medical bills, job loss, or potential layoffs, or a severe increase in your monthly loan payments are a few examples that the time for action is now. Waiting only narrows your options, lowers your chances of receiving a loan mod, and increases your FOPI score. The Foreclosure Probability Index, or FOPI, is a predictive statistical metric analysis generated by the HomeWatch tracker engine that measures a person's likelihood to lose their home to foreclosure. In other words, the higher your FOPI score, the greater your chances of losing your home. The HomeWatch tracker is used to alert you of certain milestones that you pass along the foreclosure timeline. By applying for a loan modification, you start the process of improving your FOPI score, which may stop or avoid the foreclosure process altogether. I hope this information was helpful to you. If you have questions or would like additional information on options available to you for your specific situation, come check us out at www.homewatchtracker.com. Click the button below to continue.